The regulatory crackdown is probably, in the long run, going to be good for the Chinese market.
This is one of the biggest factors behind the downgrade, the Delta variant.
We see really bullish signs for performance for 2022.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger here in London, and this is what's coming up on today's program. Credit Suisse's internal inquiry into Archegos collapse finds due diligence at fault, with the bank putting billions at risk for very little revenue. Meanwhile, Germany's Deutsche Bank weathers a slump in fixed income trading, lifting its revenue guidance for the next year. We'll hear from our interview with James von Moltke. And a big beat from tech fails to impress Wall Street. Apple sees record third quarter sales, but slides post-market after warning of slowing growth. It certainly is a strange market when you have the micro of these earnings coming head to head with a Fed decision, with growth concerns, with concerns over China as well. We are seeing, though, European equities starting to gain after a flurry of earnings from companies this morning. But even as some banks announce positive numbers, the focus, of course, returns to Credit Suisse after its internal inquiry into the Archegos blow-up finds its due diligence at fault. Bloomberg sources say that the review has found that the bank faced huge exposure, but for very little revenue. The Swiss lender lost about $5.5 billion on the collapse of Bill Huang's family office. Credit Suisse is, though, scheduled to release the results of its investigation tomorrow. Juliet Sally joins us. So, Juliet, we have the Archegos news. We have banking results as well. What kind of movement are we seeing in the banking stocks this morning with all of these cross currents?
Yeah, absolutely. Good morning, Danny. It's going to be very interesting to follow that Credit Suisse story. It seems like a litany of due diligence failures, as you say. We are seeing, though, Banco Santander shares lower by 1%. This despite the second quarter net earnings that was a beat, coming in at 2.1 billion euros. Mark and Anna, of course, talking to the CFO earlier, and we've heard from Chairman Anna Botan also saying that Banco Santander is on track to outperform profitability targets for the year. This is a stock that, as we know, has a lot of buys on the terminal, something like 20 versus only 4 sells. Deutsche Bank, of course, coming through with its numbers as well. It raised its revenue target for next year for 2022, also saying it's scrapping its cost goal following some unexpected expenses, but it was the fixed income beat, even though it fell 11%, a lot better than peers, and that's something that Bloomberg Intelligence has been looking out for as well. And then, of course, we've got Barclays now up 4%, but it has been jumping as much as 4.7%, the most since March. Also a beat, but also on the back of this buyback surprise. And even when you take out some of the provisions for the pandemic, we saw earnings top consensus by 16%, Danny.
All right, Julie, you have to forgive me. I'm going to ask you to move across industries now, because we also had the tech earnings from Microsoft, Apple, and Alphabet last night. What's the pre-market reaction so far?
I thought you were going to say I had to move the screen, but you can see these. We are seeing Apple shares a little weaker because you mentioned earlier, Danny, that even though we saw this beat, we had this very strong iPhone sales coming through. You do have this caution that rippled through from Apple, as it said that the sales growth could be slowing. Supplies are getting tight. We know that particularly very well here in Asia with the supply chain issues. Then you've got Microsoft looking like it is going to go higher. This was a beat as well. Sales and profit exceeding analyst estimates for a 10th straight quarters, but there were a little bit of signs of spookiness from investors, and this is about the cloud computing business, about Azure, because remember, it is still facing some very stiff competition from the likes of Amazon and Google Cloud. Danny.
Juliet, all over the moves for us this morning. Juliet Sally in Singapore, thank you so much. Now, as Juliet was mentioning, as earnings unfold, one of the main areas of concern is, of course, inflation. Both corporations and consumers alike are concerned about price pressures. And while some brush off the rise as temporary, others do indeed think that it's structural.
We clearly see inflation now in the United States in particular.
It is obvious that we have a very, very important spike on inflation.
I'm somewhat on the side of those who think that we may well have an incipient inflation problem.
I don't think that this level of inflation is sort of a precursor for a large inflation boost. But obviously, one needs to watch this very carefully.
There's another part of the inflation that we believe is more structural.
You have to take into account input costs going up. It's a clear area where there are some challenges today. And our instinct is this will persist for some time.
The global supply chain is not working exactly as it should be.
The rise in raw materials is such that we have to act.
So you see a bit of inflation there, but it's transitory, so it should not be a real concern.
More or less all costs have gone up, and yes, we're transferring some of that to our customer.
Right now, we do believe there's a little bit of carryover inflation, but it's too early to say.
We're joined now by Stephen King, HSBC's Senior Economic Advisor. Stephen, thanks so much for joining us this morning. And look, we've gotten a lot of commentary from corporations about the inflation concern. Some data from Bamble said that the amount that inflation was mentioned increased 1,000%. I mean, over and over again, what do you make of that, of the continual citation of higher prices for all of these companies?
Well, obviously, you've quoted a whole bunch of people who clearly are very concerned about inflation. Of course, the central banks themselves are generally quite a lot more relaxed. They're saying we can look through all this. But then quite reasonably, I would say, well, central banks, of course, will say that, because if you can't look through it, it would mean they were making a series of policy errors, which they don't really want to admit to. The reality is that we're facing tremendous uncertainty with regard to inflation, that some of it, doubtless, is associated with the sort of immediate unlocking pressures associated with the pandemic. These are sort of temporary increases in costs because container ships are in the wrong place and workers are in the wrong place. But there are other things going on which are possibly more worrisome, one of which is the fact that money supply growth was incredibly strong in the US last year. Another is that you've got a whole bunch of pent-up demand for consumer items because people have been forced into saving during lockdown. And of course, you've got a massive fiscal stimulus coming through from Biden's administration. So there are a bunch of things out there that if I were a central banker, I'd be feeling just a little bit nervous about at the moment. And also beginning to think that perhaps the trade-off between growth and inflation possibly is deteriorating. In other words, for any given growth rate, inflation is in danger of being higher now than it used to be in the past.
And don't you worry, Stephen, we will definitely dig into the Fed and their decision later today a lot. But if I can just linger on some of what we're hearing from these companies, you mentioned consumers, high, not as much loan growth. We've definitely seen deposits be very high of them. We've heard this over and over from the banking sector. What does that tell you about the consumer's willingness to go out and spend, and when we might finally see all of this money finally finish getting put to work in this economy?
Well, this is one of the great uncertainties because we've never really had the experience of living through a pandemic and coming through the other side and knowing precisely how people will behave. What we do know, though, is that the places that shut down completely, like restaurants and hospitality, have reopened. And we also know that the ability to hire people to staff those restaurants and hotels and so on has really gone down quite a long way, which is why wage pressures have picked up quite a long way. So there's a bunch of things out there that would suggest that even if there's not a volume of consumption coming through, there are certainly price pressures and wage pressures beginning to emerge.
Right. Well, Stephen, in just a little bit, I am going to ask you to look into your Fed crystal ball, so you're going to stick around with us. That's Stephen King from HSBC. Now, coming up, any tiny change of language could be crucial for traders as the Fed concludes its two-day meeting today. How will it respond to the rising wave of the Delta variant in the U.S.? We'll dig into that next. This is Bloomberg.
It does look like the Fed is going to start to, talk a little bit about how they plan to taper and when they plan to taper. At the moment, we expect that FOMC language will be fairly balanced.
We think they'll probably stay cool for now, but as we look towards the Jackson Hole meeting, we think they're going to have enough data both on the inflation, the labor market side.
And I think the market's priced fairly appropriately here for an end of the year taper. I don't think the Fed needs to push back against it.
The Fed's making things difficult for us, but I've sort of learned don't fight the Fed. It's a losing battle.
The Federal Reserve will consider adjustments to the policy statement at today's FOMC meeting, notably on inflation language and virus risks. But even as the Delta variant threatens President Biden's so-called summer of joy, Bloomberg Economics does not expect a new COVID wave to dramatically alter the economy's trajectory. Stephen King from HSBC is still with us. So, Stephen, it does feel like expectations are stacking up that we'll still have a dovish Fed, not maybe too much of a change. But what are the key points that you'll be looking for when we hear from Chairman Jay Powell today?
Well, I don't think the language is going to change hugely, and we heard plenty from a couple of weeks back. So I think the talk is going to be partly about how much of an inflation risk is out there, how much of it is transitory, are they becoming more worried about some being a sort of permanent shift upwards in inflation. I'm sure we'll hear a bit about the downward surprises in economic data over the last few weeks. They haven't been quite as robust as they were earlier in the year, and doubtless there will be a link to what's happening with the Delta variant, and maybe something more in terms of the timing of tapering. And we know they're talking about this quite seriously today and yesterday, and that's going to be the first thing to move, I suspect. But HSBC's view is that they won't actually start tapering until probably December.
Right. You know, I wonder on that. There does seem to be this growing argument that by maintaining a dovish posture, by saying, OK, we're discussing tapering, but not really giving more to the market, that the Fed potentially risks a taper tantrum, that they're increasing the odds of it. This is an argument that Matt Maley at Miller Tabak makes. What's your assessment on that?
Well, the problem in one sense is that the Fed is dealing with fundamental uncertainty like the rest of us are. And I think central bankers, when they're faced with tremendous uncertainty, prefer ideally to do nothing rather than something, because the risks of doing something and then getting it completely in the wrong direction are quite high. For example, the European Central Bank raised rates back in 2008, which I think subsequently it now regrets. So, there are significant dangers of getting it wrong rather than right when you're dealing with a lot of uncertainty.
Yeah, no, that's a very good point to kind of err on that side of caution. I wonder at this point, given the Fed's continual intervention in these markets, you look at a U.S. 10-year real rate at negative 114 basis points. Does that reflect the economic reality of the U.S. and the global market right now, or is that more just about what the Fed is doing?
I think we're really careful about trying to interpret real rates and how they relate to the economy. If you look over a very long period of time, decades, possibly even a half a century, the relationship is really not that strong. And I suspect that part of this is investors not being sure themselves as to what to do. So they buy bonds as an insurance policy against the possibility, however remote, that things go really horribly wrong. So yields are low for that reason, not because there are prospects of a deep recession coming through anytime soon.
Right. Maybe not a deep recession, but that rate of change of growth has been really focused on lately, this idea of perhaps peak growth. We recently had Goldman Sachs reduce their U.S. GDP forecast by about 1 percentage point. A lot of that having to do with the Delta variant and the services sector not picking up, that reopening perhaps not as robust in the U.S. Could you see that rate of growth also come down as we consider the fears of the Delta variant?
If I'm honest with you, I think quite a few houses have been cutting their forecasts because they were slow to cut them previously. And what I mean by that is that the trend rate of growth for the US and for Europe has been significantly lower, particularly since the global financial crisis, than people have thought previously. And there have been too many economists out there who've been saying, don't worry, we'll go back to normal. And they've recently discovered that normal is not quite as robust as they once thought it was.
Yeah, I mean, look, we've certainly seen the Citi Economic Surprise Index. Economists, many of them have gotten it wrong, that the data is surprising to the downside. I mean, what do you make of a lot of your peers out there in the world not really getting that economic call? Is it just a very difficult environment to deal with right now when it comes to the data releases?
I'm going to be cheeky here, actually. I wrote a book back in 2013 called When the Money Runs Out, The End of Western Affluence. And they argued in the book that actually trend rates of growth were now much lower than they used to be. I'm afraid to say that too many of my peers didn't read my book. But the truth is that the drivers of growth, 30, 40 years ago, just not there anymore. So for all the sort of gains in technology that we're witnessing, we're not seeing the same kind of gains coming through in terms of productivity. And therefore, underlying growth rates are much lower than they used to be. You can blame this on demographics. You can blame it on new waves of protectionism, whatever you want to blame it on. But the reality is that for a long time now, growth rates have been lower than they used to be.
Stephen, we love a little bit of cheekiness on a Wednesday. Thanks so much for joining us. Great to get your insight today. That's Stephen King, Senior Economic Advisor at HSBC. Now, coming up, we turn to Germany, and after its largest lender raises its revenue target for next year, we'll bring you our interview with Deutsche Bank CFO James von Moltke. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Credit Suisse's internal inquiry into the Archegos scandal paints a picture of severe due diligence failures. Bloomberg sources say that the review has found that the bank faced huge exposure for very little revenue. The Swiss lender lost about $5.5 billion on the collapse of Bill Hwang's family office. Credit Suisse is set to release the results of the investigation tomorrow alongside its earnings. Now, speaking of bank earnings, Deutsche Bank out with results this morning. Germany's largest lender is raising its revenue target for next year after beating expectations on fixed income trading. We spoke with the bank CFO, James von Moltke.
We have a portfolio of strong businesses in FIC, and while we did see the normalization of activity in product areas like rates and FX in particular, our relatively strong credit businesses, both flow trading, distressed trading particularly, performed very well in the quarter, and you see that coming through then in our relative revenue performance.
And so what does that tell us about the path ahead from here then, James? I mean, trading has been slowing in some areas, but you point out various parts of that strong performance that you reported. So what can you tell us about that normalization and the path ahead? Well,
we and the others in the industry have been calling for a normalization. We have been seeing that now successively over several months. Because there is a portfolio of strong businesses, we have rates, credit, FX, emerging markets. What we tend to see is weaker performance in one area is offset then in other market conditions by stronger performance in a different area. So we feel very comfortable, to your question, Anna, about the forward, because the market environment that we see going into the second half of this year and into next year is one that we think is still constructive for the businesses. And we see a high degree of client engagement around our offering, our capabilities.
And you've upgraded your revenue guidance, I think, for 2022. Can I get a bit more detail from you, James, on what's driving that? What gives you that confidence?
Well, look, we've implicitly updated our revenue guidance for 2022 because the numbers that we shared with investors in December for each of the core business units, they're either running in line with or ahead of. That gives us real confidence going into next year. We also see much less of a headwind, even in today's interest rate curve, relative to what we had planned on as far back as November, December. So we see really bullish signs for performance above the $24.4 billion that we called for 2022 when we shared those numbers with investors in December.
What kind of pressure you're seeing on wages at the moment? We recently reported that you boosted junior banker pay. What are you having to do in that area to keep up with the competition?
Well, look, we operate around the world in a number of businesses and a number of markets, and in each of those markets, there's a labor market. We obviously aim to hire the best talent. To do so, we have to pay competitively. And as you say, in certain areas, there have been adjustments necessary. In some senses, in some markets, a catch-up after some years of relatively stagnant pay. And in other areas, there are different dynamics, but we certainly see some inflation of our labor costs, as you point out, in parts of the businesses.
James von Moltke there, the CFO of Deutsche Bank, speaking to us just a little bit earlier. Let's get now to the first word news. Here's Leanne Garrett. Hi, Leanne.
Hi, Danny. Fully vaccinated tourists from the EU and US are set to be allowed to travel to England on the same basis as Britons returning from abroad. Bloomberg understands the policy will be finalised at a meeting of senior UK government ministers later today and could come into force as soon as next week. Now, Sydney's month-long lockdown has been extended by at least another another 4 weeks after daily COVID cases hit a new record of 177 infections. The announcement came as week-long lockdowns were lifted in Adelaide and Australia's second biggest city, Melbourne, which recorded 10 new cases. Around 14% of the population has been fully vaccinated. And former four-time Olympic gold medalist Simone Biles has pulled out of the women's gymnastics team final, saying, "I have to focus on my mental health." 24-year-old Biles, the world's preeminent gymnast, cited her state of mind and the risk of injury after she faltered on a vault. Sponsor Gap says they stand by her decision and do support her well-being. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
And thank you so much. And Simone Biles, always the GOAT, whether she competes in this Olympics or not. Now, coming up, time for an aperitif. We'll get an exclusive talk to the CEO of Campari about pandemic restrictions and the outlook for the spirits industry as this market digests the plethora of earnings that we are getting. This is Bloomberg. Credit Suisse's internal inquiry into the Archegos collapse finds due diligence at fault, with the bank putting billions at risk for very little revenue. Meanwhile, Germany's Deutsche Bank weathers a slump in fixed income trading, lifting its revenue guidance for next year. We'll hear from our interview with James von Moltke. And a beat for big tech fails to impress Wall Street. Apple sees record third-quarter sales, but slides post-market after warning of slowing growth. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, a lot of cross currents to go through, and certainly one of them is the rising cases of Delta, not just here in Europe, but in the U.S. as well. And in a blow to the U.S., President Joe Biden's promised summer of joy, the country now faces a surge in cases fueled by vaccine holdouts and, as I said, the highly transmissible Delta variant. This has prompted health officials to reintroduce tighter guidelines for use of masks. CDC Director Rochelle Walensky told Bloomberg that recent data suggests that some vaccinated people infected with the Delta variant can transmit the virus to others.
Information on the Delta variant from several states and other countries indicates that in rare occasions, some vaccinated people infected with the Delta variant after vaccination may be contagious and spread the virus to others.
For more, we're joined by Bloomberg Intelligence's Sam Fazeli. So, Sam, has the spread of the Delta variant very vastly changed the calculus when it comes to U.S. policy?
Good morning. Yes, it does. Everywhere, I would say, and I think I'm going to take an image used by Eric Topol to explain how this might be best visualized. Assume your vaccine is an umbrella and it's raining hard, and it starts to rain even harder. In order to avoid getting wet, you need to wear a raincoat. So it's as simple as that. You have a much more transmissible virus with higher amounts of virus in your exhaled breath. And of course, that means that if you are vaccinated and you catch the virus, you have an increased risk of also passing it on.
I see. Sam, thanks so much for giving us the latest on this. That's Bloomberg Intelligence's Sam Fazeli. Thanks again for joining us. Now, switching gears a little bit, the Italian beverage company Campari reported sales for the first half that beat average analyst estimates. The Aperol maker saw revenue of €1 billion as pubs and bars reopened across Europe. Now, despite uncertainty linked to the spread of the Delta variant and the possible reintroduction of new restrictive measures, Campari remains confident on the outlook. We're joined now by Campari Group CEO Bob Kunze-Concewitz. Bob, thanks so much for joining us. And last time you joined our program with Francine on May, you coined a term that I just loved. You had previously called this revenge conviviality. So what is the current state of revenge conviviality and how long can it last?
Well, indeed, we had a significant beat versus the market. I mean, the two words I remember from yesterday's analyst call were remarkable and incredible. And that is really due to revenge conviviality, because what we're seeing is that people post, lockdowns, they want to live. They want to entertain at home. They want to have great cocktails at home. And at the same time, they're going out very often, or more often than before, and again, having cocktails. I mean, the spirits industry is sourcing market share from both wine and beer. So we have very good foundations. And within that context, our portfolio of brands are really outperforming. I mean, if you look at it, all of our cluster of brands have grown double digit, not only versus a year ago, but more importantly, versus 2 years ago. So cleaned up of any effects of the pandemic. And that really shows the strength, the underlying strength of our brands.
Yeah, I was going to say, you talk to any of the pros, it's that 2-year growth that people care about, considering the comps last year have been somewhat easy. But, when I think about Aperol, for example, you think of a warm summer day, you're sitting outside somewhere drinking an Aperol Spritz. I mean, how dependent is that on the economy staying open and that we don't have Delta or other variants forcing people to stay at home yet again?
Well, what we saw last year, for instance, on Aperol is that Aperol grew. That's because we were able to have higher frequency amongst our existing consumers at home. Clearly, during lockdowns, we're not able to go into the on-premise, activate the brand, and recruit new consumers into the franchise. Having said this, we hope that with the growing rate of vaccination and green passes, that the on-premise will remain open and that we'll be able to continue recruiting new consumers into the franchise. But overall, though, the underlying fundamentals of the brand are very, very solid. And today, in many markets, it's much more than a spring-summer brand. People drink it all year round, and they don't only drink it as an aperitif, they also drink it with meals at lunch as well as at dinner.
Interesting. Have to get a almost like a wine tasting of what to pair Aperol with. Bob, what about extending franchises? Are you looking at any possible M&A targets?
M&A will always play a role in the development of the Campari Group. We've done something like 30 deals in the 20 years that we're a public company, and that has helped to a certain part also boost our TSR. I mean, as you know, we've been since 2001 delivering a TSR of 16% on an annual basis, and half of that growth on average has come from acquisitions. We have quite a flexible capital structure now since last year, so we're able to consider all sorts of deals from small add-ons to really large transformational deals. Ours remains a very fragmented industry, so we're here for the long term, and we'll wait for our turn.
Speaking of large transformational deals, I know you have a JV with LVMH and Moet Hennessy. What's your current relationship like with LVMH, and what do you make of sort of the rumor mill speculating of a potential buy of Campari by LVMH?
That's an interesting one. I think our majority shareholders, the Garavaglia family, are in here for the long run, and the move which we made last year to relocate our legal seat to the Netherlands is definitely to enable us to have more flexibility in the capital structure, enable the family to remain in control of the company, but actually really live significant sums. We're much more in the frame of mind of consolidating as opposed to being consolidated. Having said that, we have a lot of respect for Hennessy. They're a great company. They have a great portfolio of brands. It's very complementary to ours. And we've decided to join our efforts in wine and spirits e-commerce in Europe. It's only focused on Europe. And anything outside of that joint venture, we're competitors.
Right. Very diplomatic of you, Bob. Another thing that has come up over and over again across industries from executives has been inflationary pressure. Quickly here, Bob, what has inflation and pricing pressure looked like at Campari?
Well, the biggest inflationary pressure we've seen in the past 3 to 4 years has been in the price of agave, which is the raw material which goes into the distillation for the production of tequila. I mean, the prices went from 5 pesos to about 30 pesos in about 6 years. And the industry is still, dealing with that, although the price has stabilized. Looking forward to next year, we're seeing inflationary pressures on inputs, dry goods, particularly packaging materials, as well as sugar and alcohol. Having said that, we estimate that will be about 3% increase on our cost of goods, so roughly 1.2% overall company, and we'll be able to compensate that via pricing.
Right. Bob, unfortunately, we're out of time. Also am told that I should wish you a happy 20-year anniversary of listing publicly. That's Bob Kunze-Concewitz, CEO of Campari Group. Thanks again for joining us. Now, coming up, we look at wealth management, and the Queen's Bank joins the rank of ethical brands. Coutts has secured B Corp status. We discuss what that is. Up next, we speak to its CEO, Peter Flavel. And if you have any questions for him, IB plus TV Go on your terminal. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's talk about mixing purpose and profit. B corporations are for-profit companies that meet the highest standards of verified social and environmental performance. Now they are legally required to consider the impact of their decisions on stakeholders. In a way, B Corps are what companies to what fair trade is to food companies, rather. There are more than 4,000 certified B corporations around the world, and our guest this morning is from a company which has just achieved such status. In fact, the first private bank and wealth manager to do so. We are joined by the CEO of Coutts & Co., Peter Flavel. Peter, great to have you on. Congratulations about the B Corp. So what exactly does that mean for Coutts and the way that you do business?
Well, Danny, the process around wanting to become a B Corp started off by us looking at our environmental and social and governance activities and asking ourselves, how do we hold ourselves to account and how do we measure that progress? And we knew about B Corp and we knew about the verification process that we had, but the more we got into it, the more that we realized that actually the heart of this is all about redefining what success means for you as a business across the way that you govern the business, across the way that you deal with your employees and your customers and clients, and your impact on the community and the environment. And they're the five areas that B Corp look to make sure you're upholding these high standards.
What does that mean for investment strategies? For example, have you had to divest from anything in order to meet this type of standard?
So we started on looking at ESG through our investments around 4 years ago. And we asked ourselves, should we have a separate set of green funds alongside our existing funds? And we then said to ourselves, but actually, if you believe in this, as we do, then all of your funds should have environmental filters. So all of our funds have environmental filters. We don't have a separate set of green funds. So ESG filters are core to what we do. It's the way that we only invest is through this way. So that does mean that we've excluded things like tar sands and thermal coal, etc. But we also want to see players in particular industries commit to a net zero path, a sustainable and believable net zero path. And as long as they have that sustainable and believable and verifiable path, then we'll continue to invest in them.
Obviously, ESG matters, very important to investors now, but I'm also wondering, Peter, more broadly, when you talk with your colleagues and your clients, I mean, it's certainly an odd time in markets. What stands out as the big risks and fears that they're trying to deal with in this market environment?
Well, just on the ESG front, when everyone thinks of Coutts, we think of traditional wealth and landed estates. The core of what we do is we bank 20,000 successful and influential entrepreneurs here in the UK. And a number of those are already B Corp, and that's one of the reasons we started on this journey. So what we're looking to do is once we get ourselves in a place we're comfortable and getting our accreditation, our plans to improve in the future, because you have to commit to improve in the future, we think we've got a real role to play to help as many of those 20,000 entrepreneurs join us on the path to B Corp. So that's the first thing. The second thing, though, is that being the first private bank and wealth manager, we want other private banks and wealth managers to join us on the journey, because this is not a competitive thing.
So, Peter, if I can kind of shift a little bit, what about inflation? How concerned are clients about that current environment?
Well, I know it's been a topic all morning for you, and there are views on either side of it. Is it real? Is it just passing? And I think the view in the middle is it's too early. It's too early to tell. When I talk to clients though about inflation, I really want them to think about how much money they've got in cash. So through the pandemic, people have not been spending, and you can see the deposit balances across banks have gone through, really grown very strongly. So how much money do you have in cash, and what's the impact on your overall returns by having that money in cash? Because we know cash returns are low, if not negative, in some currencies. So for our clients, actually, I'm asking them to think about being invested, because it's about time in the markets. It's not about time in the markets.
Yeah, that's such a good point. I mean, looking at where real yields are, for example, there's not a lot of return from a lot of the bond space. So how are you seeing your high net worth clients put that cash to work? What kind of assets and types of instruments are they going towards?
Well, we're a multi-asset, well-diversified set of funds. And so we talk about, as I've already said, time in the markets, long-term returns, sustainable, reliable, sustainable returns. You don't come to Coutts for the latest IPO or the latest structured product. That's not what we do. We're looking after families' wealth for generations. So this is safe capital that wants to be protected and wants to grow faster than inflation, which means it needs to be appropriately invested across a broad range of assets in a cost-effective way. And increasingly, we're using a lot of passive vehicles to ensure that the cost of delivering that investment return, which we're very proud of, first quartile returns, we're very proud of our investment returns. And you'll see in our results in the next couple of days the growth that continues on our investment AUMs as a private bank and wealth manager.
Interesting. Also within the Coutts world, I mean, we've heard from a lot of banks that are facing this issue of talent retention. It means bonuses are getting higher, wages have been getting higher. What's the current picture and state of play when it comes to that at Coutts?
Well, being a purpose-led organisation, the NatWest Group is a purpose-led organisation wanting to help families, businesses and communities thrive. And Coutts, part of the NatWest Group, is a purpose-led organisation. That's what B Corp is all about. And I can tell you that's what our staff want to see. They want to feel as if they're working for a company that has a purpose. And as you probably expect, younger employees and younger staff members, that's probably a bigger issue for them as well. But it's a big issue for our clients as well. We've been pleasantly surprised in the communications that I've sent out to all our clients. The response back from clients has been really, really positive.
Peter, thanks so much for joining us this morning. That's Peter Flavel, CEO of Coutts & Co., which just received B Corp status. Now let's stick with the banking industry, and Credit Suisse's internal inquiry into the Archegos scandal paints a picture of severe due diligence failures. Bloomberg sources say that the review has found that the bank faced huge exposure for very little revenue. The Swiss lender lost about $5.5 billion from the collapse of Bill Hwang's family office. Credit Suisse is set to release the results of their investigation tomorrow alongside earnings. Joining us now, our finance reporter in Zurich, Marian Hofsmeyer. Marian, what can we expect in this report that we're getting tomorrow?
Hi, Danny. Yes, so, I mean, there's no other way to put it. This is pretty scathing, and it really is showing that Credit Suisse is screwing up when it comes to really managing the exposure and the trade that they had with this client. So what we're expecting to see in this report is undoubtedly a little bit more explanation as to how this all happened and where the system broke down. Ourselves and other publications have been reporting about how they gave a lot of leverage to this client for little collateral and little revenues in return. And on top of that, there seems to have been a little bit of a breakdown in reporting about these risks upwards up the chain, where some key executives don't seem to have been aware of the largesse of the exposure that they were facing.
Yeah, with that in mind, a simple question, but probably not a simple answer. Who's responsible?
Yeah, definitely a simple question, but not simple answer. So we know a few have taken responsibility. The chief risk officer has departed. The heads of the prime brokerage unit have departed. The head of the investment bank has left as well. So definitely some people who have stepped down and taken quote unquote responsibility. However, we have to remember this is a huge hit. This is wiping out more than a year's worth of profit. It's still going to be dragging down earnings that will get results tomorrow as well. So it remains to be seen whether there's more responsibility to be taken here, and whether, how they could even fix this.
Right. Marion, thank you so much. We'll definitely keep on top of these details, especially for tomorrow's release. That's Bloomberg's finance reporter in Zurich, Marion Haftermeyer. Now, big tech beats, but fails to impress Wall Street. Apple, Alphabet, and Microsoft rake in $57 billion of quarterly profit, but they're warning that sales may slow down in the months to come. We're going to bring you all the details of that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now turning to big tech, where profits have surged to unexpected heights, but the results failed to impress Wall Street. Microsoft sales beat for the 10th straight quarter, and Alphabet's revenue rose again. Apple also set records with its results, but warned sales may slow amid tight supply. Here to break down the latest results is Bloomberg Quick Take reporter Alex Webb. So, Alex, why was Wall Street just so underwhelmed after very strong results?
It's a slightly different picture for each company, but we do always often see that when these tech companies report really good earnings, and particularly in Apple's case, they didn't give any guidance for the upcoming quarter, there's some profit taking. That investors think, well, is this as good as it's going to get? Maybe now's a good time to cash out. These companies are trading at fairly exorbitant multiples already. Slightly different picture with Google, which did give a more bullish outlook. It is an advertising company or advertising technology company. That means that as the economy recovers, people spend more on ads. Google is likely to track that to a greater extent than would Apple or Microsoft. Okay, so does that mean big expectations then when it comes to ad revenue from Facebook? It does. The thing with Facebook is that they are going to be under slightly more pressure than Google because they are dependent upon, to a great extent, Apple and Google's own Chrome browser to reach their audience. Both of those companies, Apple and Google, are cracking down from a privacy perspective, making it a little bit harder to track people across the internet, and whether that has an effect on Facebook's outlook, I think is going to be significant. Alex, thank you as always. Wonderful to get your insight on a big earnings day for tech. That was Bloomberg Quick Take reporter Alex Webb. Now, Bloomberg Surveillance Early Edition will continue in the next hour. Matt Miller and Kailey Leinz join me from New York. It is a market day where there is just so much to digest between the various earnings that Alex was just talking to us about, be it tech, be it the banking sector, as well as a Fed decision. So we have the meeting of the macro and the micro coming head to head as markets move nominally higher. This is Bloomberg.
When we institute mandates, you see vaccination rates go up, and I think it illustrates confidence in the vaccines because they are safe and effective. This should be a non-controversial vaccine.
This is one of the biggest factors behind the downgrade, the Delta variant. Now, we're seeing cases going up in the U.S. too, and other parts of the world.
We're taking nothing for granted in this environment, but that said, we don't see signs today of that being a major impediment. But again, a watch item to be sure.
This is Bloomberg Surveillance Early Edition with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, July 28th. Our top stories today: Joe Biden's summer of joy turns into a nightmare. Blame the Delta variant and vaccine holdouts. Facebook up next. The social network reports earnings after some of the tech's biggest names beat estimates. But Apple warns that sales growth may slow. And European bank surprise, Barclays Investment Bank brings in a record haul, while Deutsche Bank raises its revenue target. I'm Danny Berger in London with Matt Miller and Kailey Leinz, both in New York. Francine is off this week, and it is a complicated day for markets, Kailey. We are moving higher from here, but we have the merging of the macro picture with the earnings and the macro picture of a Fed. I mean, it's definitely a complicated market to navigate in.
Well, of course it is, Danny, and also this market has to consider the equation of China and the crackdown we are seeing on different industries there. That said, sentiment did seem to improve in the Asian session, at least in China and Hong Kong. You did have Japanese equities lower by about 1.4% on the day, but in China they closed higher by about 0.2%. You have state media talking up the markets, trying to stem the 3 days of losses. That seems to have worked for now, and the Hang Seng Index, the outperformer, up about 1.5%. The Hang Seng Tech Index also has seen a bruising last 3 sessions, down 16% in the 3 days prior to today, but a little bit of a recovery today, up about 3%. One stock also that had seen a lot of pain lately was Tencent. It, though, closed marginally higher, up about 0.3%. In foreign exchange, I would note we're also seeing a recovery for the Chinese yuan. It's the big outperformer in Asia today, stronger against the dollar by about 0.3% to right around 6.5. And then, of course, the underperformer is the Korean won. It's right around a 10-month low, weaker against the dollar by 0.4% today as South Korea reports record COVID cases there. As for the picture here in the U.S., we did see some selling yesterday. Actually, the worst day for the NASDAQ 100 in about 2 months. A bit of a recovery taking shape in futures this morning, though, ahead of that Federal Reserve decision. Right now, S&P 500 futures up about 8 points. In the bond market, we're seeing the yields tick slightly higher, up 1 basis point on the 10-year to just around 125. And real yields ticking up as well from those record lows that we saw yesterday, right now around negative 112 basis points. Finally, Matt, I feel like I went a long time without talking about Bitcoin, and now I seem to be talking about it every day because it is moving higher for the 8th day in a row, up 4% today, on pace for its longest winning streak of 2021 thus far, just under that $40,000 level.
Well, when it's hot, and that's why we're paying more attention to it now. For a while, we were worried about a crash. Now we're talking about 50,000 again on Bitcoin. But really, I think the focus, especially in Europe, is on bank earnings, on Barclays, on Deutsche Bank, on Credit Suisse and Archegos. We have gains across the board, but they're not huge gains. We're looking at bigger gains in Spain and in France than we are in Germany. That's really fascinating because Deutsche Bank shares aren't gaining. Normally, you'd think they raised their revenue target. We should see shareholders give even more trust to Christian Saving. After all, he's done really well with his turnaround plan, but costs are higher, and maybe that's one of the concerns. Here you see the FTSE 100 gaining about 0.2%. The Stocks Europe 600 up about 0.4%. So there are some gains. They're just not really big. Barclays is a bigger gainer. I think it's up about 4% right now, Danny. So Barclays is really, I think, the winner story today. The loser story could be Credit Suisse. Can you believe Archegos gave Bill Wang, tens of billions of dollars in exposure and didn't generate any revenue from it? Almost no revenue. I mean, how did that happen?
I thought it was supposed to be high risk, high return. I don't think what you learn in the CFA is high risk, no return. I think someone's got that equation wrong, Matt.
Yeah, it seems to be a failure that we're going to learn a lot more about tomorrow when we get that report. But I think bank earnings are front and center. And then, of course, we got to focus on the big raft of tech earnings we got. And, of course, we're going to talk a lot about whether or not vaccinated people have to wear masks indoors.
Right. And of course, within those earnings, we also have the concern about inflation. A lot of things to dig through. And look, we have a lot more ahead today as well, Matt. So let's take a look at what's ahead. We'll get second quarter earnings from Facebook and Ford. Pedro Castillo also takes office as Peru's new president, and that follows weeks of vote recounts. Then at 10:30 a.m. New York time, the EIA releases its crude oil inventory report. Crude, of course, very important after last month's dust-up between OPEC. And then the biggest event of the day, hopefully there'll be some excitement in there, the Fed rate decision at 2 p.m. And that, of course, is followed by a news conference from Fed Chair Jerome Powell. So a lot to look out for today. Now, the virus has also been front center when it comes to the Fed and really for the entirety of these markets, because call it a reality check for the whole world. The U.S.'s reign as the best place to be during the COVID era, it really did not last long. Its vaccination drive has stalled, and there's been a new surge of cases. So Norway now is the new #1 in Bloomberg's COVID resilience ranking. It has enough shots administered to cover almost half of its population, and its borders are open. Coming up second is Switzerland, followed then by New Zealand. At the bottom of the 53 countries ranked is Indonesia, where more than 1,300 people are dying of COVID every day, and there aren't enough shots for a large population. That reinforces a rich-poor divide in the rankings. Bloomberg's COVID resilience ranking comes as the CDC also reverses its mask guidance in a bitter setback for President Biden. Sam Fazeli, Bloomberg Intelligence senior pharmaceutical analyst, joins us for more. So, Sam, is it just logical then, if we have the U.S. falling in this ranking, that we then would need a mask mandate put in place for many places across the country?
Yeah, I think the two do go hand in hand together, because at the end of the day, it's all to do with the Delta variant, which is, like everywhere else, has taken hold in the U.S. and pretty much close to 90% of cases based on some of the data that I look at. And it is a variant that when you catch it, makes you, at least at the beginning, have much higher amounts of virus in your respiratory system. So vaccinated or not, if you catch it, you're more likely to pass it on. So it does make sense that the CDC goes with what the data suggests.
So essentially, if I'm a vaccinated person, I'm just wearing my mask to protect those that are unvaccinated, Sam? Is that really what is going on here, or am I a vaccinated person at risk?
Well, some people laughed at me when I said I continue to wear 2 masks when I'm out in spaces where I'm not sure who's vaccinated or not. This is all to do with the Delta variant. If I'm going to be faced with somebody who's got 1,000 times more virus in their exhaled breath, it's more likely that I'll catch it if I had 1 mask. If I had no mask, if I had 1 mask, if I have 2 masks, it just continues to reduce my risks. So
go for 3 or 4.
5, 6. No, but look, at the end of the day, there has to be some limit, because I still also need to breathe. So, but certainly, I think it all goes hand in glove. It is entirely to do with the characteristics of the Delta variant.
Sam, thanks very much. Bloomberg Intelligence's Sam Fazeli talking to us about the mask mandate news. In earnings news, back to earnings news, Deutsche Bank is raising its 2022 revenue target. We spoke with the CFO, James von Moltke.
We've implicitly updated our revenue guidance for 2022 because the numbers that we shared with investors in December for each of the core business units, they're either running in line with or ahead of. That gives us real confidence going into next year. We also see much less of a headwind, even in today's interest rate curve, relative to what we had planned on as far back as November, December. So we see really bullish signs for performance above the 24.4 billion that we called for 2022 when we shared those numbers with investors in December.
Bloomberg's Juliet Sally joins us now with a breakdown of what we heard from a couple of European banks and what we're preparing to hear from another. Juliet?
Indeed, Matt, you said it before. Of course, these bullish signs that we just heard, they're really going to set Deutsche Bank up for that positivity. You've got shares, though, fairly unchanged at the moment. What was really interesting, though, was what was happened in their fixed income trading. It fell by 11%. That was a lot better than its peers, including Barclays, which actually saw its fixed income trading revenue fall by 39%. Barclays, though, is seeing 2021 costs above 2020. And importantly, they announced this £500 million share buyback, which is supporting its shares up by 3.7%. They have been up by as much as 4.7%, the most since March. We were also speaking to the CFO of Banco Santander on a European market open, talking there about the beat here, net income coming in at 2.1 billion euros, and Chairman Anna Batan saying that Banco Santander, Danny, is on track to outperform its profitability targets for the year.
Yeah, I mean, just even looking at that performance, very uneven among the banks. And I mean, speaking of idiosyncratic risks, Bloomberg learning some news out of Credit Suisse and Archegos about the very little return they would have gotten from Bill Hwang. So what do we know at this point, Juliet?
Yeah, you put it really well there when you were saying, or what do you do in terms of high risk and no return here? Because we are hearing from this internal report from Credit Suisse that the bank basically failed to gauge tens of billions of dollars of exposure to Bill Huang's family business that was basically providing little or no return. Now, the actual report is likely to be made public by Credit Suisse itself tomorrow, but we know that this has caused a litany of potential due diligence failures here and has led the bank to a lot of head scratching. We've already heard that Chief Risk Officer Lara Warner has left Bloomberg, breaking the news yesterday that she will be replaced by Goldman's David Wildermuth, and there could be some potential more changes ahead, according to Bloomberg Intelligence here too. Goldman is one of the banks that had little exposure to the Archegos fallout, which of course we know hit Credit Suisse's prime brokerage business pretty hard, Kailey.
All right, thank you so much to Bloomberg's Juliet Sally with a big recap of all the European banks there. And I want to recap the big tech earnings we got after the bell last night. Those are the stocks I'm focused on in pre-market trading here in the U.S. today. Of course, the three of them we got combined represent $6.5 trillion of market capitalization, the biggest, of course, being Apple. The issue with Apple isn't the quarter it just reported. Record revenue of $81 billion, well exceeded analyst estimates. Thank you very much to 50% growth in the iPhone. The issue is that the company warns of slowing growth and specifically supply constraints, aka the chip shortage, weighing on iPads and iPhones. Plus, they say services demand may slow down, so that is dragging the stock lower by just about 1% in early hours. The other $2 trillion plus company, of course, is Microsoft. It beat on both the top and bottom line for the 10th quarter in a row. Revenue up 21%. A bit of an issue with its cloud computing business. It, on a constant currency basis, did see growth slowing. That initially had weighed on the shares, though investors now seem to be focusing on those beats with the stock up just about 0.4% in early hours. And finally, the big winner of the three tech giants that reported yesterday was Alphabet, of course, Google's parent company, really benefiting from the rebound in ad sales as the economy reopens. And YouTube saw ad sales up 84% in the quarter. Plus, you had the cloud business beating expectations as well. All of that together giving a nice lift to those shares, up the better part of 4% in early hours, Danny.
And Kailey, these are also so important if you just hold the index. I looked at H move on your terminal, great function to see how much each stock has moved the index. Apple alone this month, 17.5%. It's responsible for the move in the S&P 500. So very important to keep an eye on those moves. And we'll continue to do that. Coming up this hour, we have James Athey, Aberdeen Standard Investment Director. And later on in tech earnings, we have Eileen Burbidge, Passion Capital Partner. And after that, on the virus, we have Dr. Gigi Gronvall of Johns Hopkins. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York. Danny Berger is in London. Francine is off this week. I don't want to lose sight of the China story because it continues to develop steam. Now they're starting to clamp down on real estate after dealing with fintech and ed tech. And what I'm looking at here in this chart, and I want to welcome our listeners on London DAB Digital Radio. I remember to do that every time I pull up a chart because you can't see it, but I'll walk you through what's here. The FTSE China A50 index is the blue line, and it's been rising over the last couple of years until the big drop that we're witnessing now. And you can really pick any Chinese index. They've gotten absolutely slaughtered as the Communist Party starts to clamp down on these capitalist companies. Now, it's also got the MSCI World Index, which continues to rise and doesn't look like it's been affected by the drop in Chinese stocks. But the last time this happened in 2015, it took a few months before global stocks recognized what was happening in China as well, and then followed with another drop. Let's bring in James Athey, Investment Director at Aberdeen Standard Investments, to ask the question. Well, first to say good morning, James. Good morning to you. And then I'll ask the question, is what we're witnessing in China going to eventually affect global risk assets?
And morning to you, Matt. Yeah, it's a good question. The honest answer, of course, is I don't know. I think one of the features of the let's call it post-crisis financial markets, although it's probably been going on a bit longer than that, is just the extent to which certain asset classes have desensitized themselves to sort of marginal changes in the news flow. And so what you need is a build-up of counter consensus news, I'm going to call it realistically. I mean, bearish news. You need a build-up of that news before markets feel compelled to act. We even saw that in the first quarter of 2020, where even as it was becoming immediately obvious that this virus is going to be an issue, equity markets didn't react. We saw the same in 2007, even after we'd seen problems with gating of funds and even the default of Bear Stearns. You still didn't get equities reacting until much later in the process. So it
James,
wouldn't surprise me if there is just a lag.
Talking about a lagging reaction to the virus, when you think about the Delta variant, do you have to recalibrate your growth expectations?
Me, no, because I think my view is that the market was taking an incredibly rosy view. At the back end of last year, at the beginning of this year, I just felt that the market consensus view had no slack in it whatsoever, no redundancy, no risk premium at all. It was essentially priced at the upper end of the distribution based on all of the inputs into that growth forecast. My view was, just from reading and understanding our history with viruses, was that it was more likely that this virus would linger and continue to have a negative impact on the economy for a bit longer than the market was expecting. But yes, in terms of asset prices, you should expect that there should be some reaction. But again, in US equity markets, it's very difficult to observe that reaction at the headline level. You see it more in sector rotation.
Let me zoom out a little bit then and talk about EM, because yesterday I was speaking with IMF's Gita Gopinath, who said, look, in 2025, the U.S., the advanced economies, they won't have any scarring, but because of the divergence in vaccines, emerging markets still will. What do you do with EM at this point, James?
I mean, I dislike it. I disliked it anyway. I dislike it more today because I think the dollar dynamics have changed. I think the dollar is one of, if not the most important inputs into your EM investing thesis. I mean, big picture, EM had an opportunity with China's building program, let's call it, throughout the 2000s, and particularly post the crisis. EM had an opportunity to fix their roofs while the sun shone. They didn't. They got even further indebted at a time where they were really benefiting from this one-off shock of commodity demand from China. So I see structural weakness there. I see a lack of a growth model. And once the dollar starts rallying, that's never a good thing for EM.
James, one more quickly from me. It is Fed Day. What is the number one thing you are looking to get out of the Fed and the chairman today?
Great. I mean, the number one thing I'd like to get is some clarity and understanding of what on earth their reaction function is and why on earth they're still buying 120 billion of assets with growth at 8% and inflation at 5%. But I doubt we'll get any of that. So I think Jay Powell wants this to be a pass. He wants this to go off without a hitch. There's no new dots. There are things happening in either direction, high inflation prints, but markets are repricing as if they're worried about growth in the future. He doesn't really want to validate either side. So I think he'll try and be very cautious, very centrist, some positives, some negatives, and hope that the market isn't too destabilized by either.
I expect he'll say the word patient a lot today. Thank you so much, James Athey, Investment Director at Aberdeen Standard Investments. And be sure to stay with Bloomberg for our coverage of that Fed rate decision and the news conference from Jay Powell. That begins at 1:30 p.m. in New York, 6:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Danny Berger is in London. Francine Lacqua is off this week. Now let's get the first word news. And two key U.S. senators say they have reached a bipartisan deal on spending more than $2 billion to pay for security at the Capitol. The money also would be used to resettle Afghan nations who helped American forces. Senators Patrick Leahy and Richard Shelby are pushing to get the bill passed by the end of the week. It would reimburse Capitol Police and the National Guard for the money spent in the January 6th riot. In China, the government will up the stakes after trying to tame property prices for years. It's attempting to break a cycle of gains that has made homes increasingly unaffordable. In recent days, China jacked up mortgage rates in a major city and vowed to accelerate the development of government-subsidized housing. It also plans to increase scrutiny on financing of developers and title transfers. The British government is about to end the quarantine for visitors from the U.S. and European Union. That is if they have been fully vaccinated. Instead of isolating now, those travelers would have to take COVID tests before leaving for the U.K. and after they get there. And at the Summer Olympics, U.S. gymnast Simone Biles won't defend her title in the individual all-around final competition. She withdrew from that event today, a day after she pulled out of the team final. According to USA Gymnastics, Biles will focus instead on her mental health. The organization says she'll be evaluated daily to see if she will take part in next week's individual event finals. And coming up next, Eileen Burbidge, Passion Capital partner, will be joining us to talk all things big tech. Apple, Alphabet, and Microsoft out of the way, Facebook on deck today, and of course Amazon reporting tomorrow. We'll break it all down. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Matt Miller and Kailey Leinz alongside me, both in New York. Francine Lacqua is off this week. Guys, it is a big week for tech earnings, but Matt, within all of that, we also have Robinhood's IPO on deck. Just yesterday, I love this, the Bloomberg team looking through new code at Robinhood saw that they're working on features to allow you to invest your spare change. I don't know exactly what that looked like. It sounds interesting.
Like acorns, basically. I think it's pretty interesting, and it'll be fascinating to see how the IPO goes because, of course, they're going to give a lot of it to retail investors in a move that is very un-Wall Street. You know, typically you put these shares into syndicate and big brokers give their big clients a bite. But now retail investors are going to be able to get some. Of course, it's going to be much riskier than many previous IPOs, but you still may see that pop. And that's what retail investors are hoping to take part in. I also like the ticker, HOOD. Not sure if that's a good ticker or a bad ticker. Do you want to be invested in Hood?
I don't know. I think it's cool. I just think anything that you can just say and not have to say each letter, that's kind of the way it goes. You get some nice status from having a word as your ticker. It's like license plates, you know, you want a cool one. But away from the IPO market, Kailey, what else is going on here? I mean, are we all just kind of waiting and seeing what comes out of earnings in the Fed?
Yep, 2 p.m. Eastern time for that Fed decision, and of course more mega cap results coming after the bell today and tomorrow. So it is a lot for the market to digest on top of the situation in China, which really roiled equities earlier this week. That is not the case, though, this morning. As we await that Fed decision, we are seeing stocks in Europe and the U.S. right around session highs. Right now, we're up about 0.5% on the stock 600 in Europe. And here in the U.S., of course, it was the NASDAQ 100 that underperformed yesterday, down a little more than 1%. Actually, its worst day in about 2 months. Today, though, those futures are actually outperforming, up by about 0.3%. In the bond market, as traders await any kind of clues we may get on tapering, when and where it starts, of course, up 1 basis point on the 10-year yield. 125 is where we sit. In Bitcoin, meanwhile, heading for an 8th consecutive day of gains, the longest winning streak of the year thus far, up about 4.6% to just under $40,000. Of course, it also is earnings season. We got a number of reports after the bell yesterday, and not all of them were positive, Starbucks being one. Yes, you saw global same-store sales up 73%, beating expectations. China, though, did not beat expectations. Actually, a slowdown there is causing some concern. That stock down about 2.3%. And then, of course, we got that trio of mega cap results after the bell. For Apple, the concern isn't about the quarter that just reported with 50% growth in the iPhone. It's the fact that it says it will slow going forward, and they didn't actually provide a quarter forecast for the current quarter. That stock down 1%. Alphabet, though, up the better part of 4%. It beat across the board on everything, really benefiting from a rebound in digital ad sales. And then Microsoft also beating expectations. A little bit of a slowdown in the cloud computing business, but not weighing too heavily on the shares. They're up by about 0.25%, Matt.
Listen, Dan Curtis, who is our award-winning producer here in New York, I think he's like an Olympic-level rower as well. Put together this chart for me. Yesterday, we had $9 trillion in companies, U.S. companies, reporting earnings. But what this shows, and I'll describe it for our listeners on London DAB, is that every quarter they beat by more and more, or more companies, I should say, in the S&P 500 beat the street's estimates. 88.5% of companies that have reported earnings so far have beat the street. This chart goes back to 2012, and we just continue to hit new highs. My question, Danny, is that because companies are just doing better and better, or is it that analysts are just not challenging them enough?
Interesting. I mean, we have seen analysts a lot of times scramble to catch up with the earnings, upgrading after upgrading. But Matt, I think that picture and all those upgrades bring us this fear of, have we reached peak earnings? It's very real this season.
Yeah, well, I mean, I just think that they're not trying hard enough. You know, I mean, why don't you just take whatever your estimate is and raise it, add another 25%?
Shut it down, Danny.
Shut
it down.
Yeah. Is that I love that. That's the model. Take what you got, add 25%. Doesn't matter the company, the industry. You know, that's the way to go. Well, anyway, look, we had big tech profits surging to unexpected heights, but the results did fail to impress Wall Street. Apple warned that sales growth may slow and supplies are getting tighter. Let's hear from Apple CEO Tim Cook on the impact of 5G.
We're only in the early innings of 5G, but already its incredible performance and speed have made a significant impact on how people can get the most out of our technology.
Let's get more into these tech earnings. Joining us now is Eileen Burbidge, partner at Passion Capital. Eileen, first off, thanks so much for joining us this morning. So have we seen the peak growth at Apple? Is it all downhill from here?
I think I remember having that question asked to me maybe 3 or 4 years ago when I was on with Fran here in the London studio. You know, I think it's not the peak. I think what we're seeing with all of these results and coming out of the pandemic is that tech is definitely no longer its own isolated sector. It really does reflect the greater economy. I think it was Satya Nadella who said that it's 5% of global GDP. We're seeing that, you know, services, delivery, advertising, eyeballs, any kind of product, it's being digitized, it's being served online, and it's being served by the big platforms primarily.
I wonder, you know, when I used to live in the U.S., Apple had a history of crushing the street's expectations and then really disappointing on the outlook. I thought they were just constantly under-promising and over-delivering. Is that what they're doing now, or are there really big concerns about supply chains and chips?
I mean, I think, you know, I really like sort of Tim Cook's approach, you know, that he's sort of cautioning, listen, we might not be able to maintain this for the current quarter. It does seem to be pretty extraordinary. And I think he's acknowledging that and sort of saying, listen, you make all the guesses you want, you make all the predictions you want. We're telling you what we're seeing, which is supply chains got to catch up. And he also made the comment that their quarter would have been even stronger had they not had supply chain issues. So he's sort of saying this could be a problem. Having said that, you know, the stock performance and the reaction after the results came out, yes, they dipped a bit, but that's because they'd already had a run in the couple of days right before the earnings came out. So everyone was already anticipating this was going to be a pretty blockbuster quarter.
Well, Eileen, that brings me to a question. Matt Miller and I yesterday were laughing about the fact that we're now talking about $2 trillion companies. I mean, it's an unbelievable number when you think about the market capitalization of stocks like Apple and Microsoft. Is that really justified given what we are seeing out of these reports?
Well, I mean, if you look at the combination, I think I saw of Apple, Google, and Microsoft, they were generating revenue of $5 billion a week in aggregate during the quarter. I do think that justifies trillion-dollar sort of valuations. It doesn't really surprise me. You have, you know, just YouTube alone within sort of the Alphabet portfolio generating $7 billion of revenue from advertising in the quarter. These are big, big numbers. So the valuations are based on revenue. They're based on top line, and they're also based on EBITDA. So I don't think it's, you know, it's completely irrational. Obviously, everyone continues to price in future earnings and potential as well. But so far, it doesn't seem like that's actually irrational.
I wonder then how much you would read into, of course, say for Alphabet, which did move higher after its earnings, the big tech giants falling after they report. Can you just kind of step back and say, okay, I don't really care about the action today just because they are trading at frothy levels?
Well, I don't know that I would say I don't care, but they're definitely frothy. I agree with that. I think what's interesting is that everyone gets so excited anticipating the results that you see the run up in a couple of days before the results. And then people go, okay, that's exactly what we expected, or I knew that was going to be the case. And then they take their gains off the table. And so I think that's the trend that we're seeing. Whereas before, maybe you had people waiting until the results came out. Now people are saying, you know what, I think this is going to be a good quarter, and trying to get in before the results come out. But that is sort of preempting everything, and that's why you had the dip on the Apple side. I don't think, though, it's necessarily reflective of sort of, you know, reality as such. It really is about the level of enthusiasm before the announcements and then right after the announcements.
You know, in terms of Amazon, I spend more time now just looking for stuff that I might need. Plus, I have subscriptions for like toothpaste and paper towels. I'll never go back to buying those at the store. How much of the pandemic behavior that we've picked up from lockdown is sticky?
Oh, I think much of it is. I mean, if you look at, food delivery services, you look at consumption of, for instance, even what's happening with the Olympics and how much sort of digital broadcasting has taken over sort of traditional broadcasting. People are still, really exhibiting the behaviors that we had from lockdown. So we're not back to normal as such, especially here in the UK, I don't think, as compared to, say, Florida and the States. And I do think a lot of habits that people picked up working from home, it's not going to necessarily go back to normal just like that overnight. Certainly as we start to see, Delta variant kind of take hold in various countries, even with travel restrictions lifting, I think people are still going to take the convenience that they got online and the sort of comfort they got with services and product delivery online from the pandemic, and they'll take that forward for a long time to come.
All right, Eileen Burbidge, partner at Passion Capital, thank you so much for your insight today. And coming up next, we'll have some insight on the pandemic and the CDC's new mask guidance. Dr. Gigi Gronvall, Johns Hopkins Center for Health Security Senior Scholar, will be joining us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, U.S. Commerce Secretary Gina Raimondo. That's coming up at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Francine Lacqua is off this week. Well, on July 4th, President Biden declared America's independence from the coronavirus. 3 weeks later, and that sense of victory is evaporating. The U.S. now faces a surge in cases fueled by vaccine holdouts and the highly transmissible Delta variant. That reversal of fortune is prompting the CDC to reverse its mask guidance and recommend that some vaccinated people wear masks indoors.
We believe the vast majority of transmission is occurring in unvaccinated people and through unvaccinated people. But unlike the Alpha variant that we had back in May, where we didn't believe that if you were vaccinated, you could transmit further, this is different now with the Delta variant, and we're seeing now that it's actually possible if you're a rare breakthrough infection that you can transmit further, which is the reason for the change.
Dr. Gigi Gronvall, Johns Hopkins Center for Health Security Scholar, joins us now for more. So, Dr. Gronvall, basically this is to protect unvaccinated people and vaccinated people from then infecting those who are unvaccinated. But if even vaccinated people have to wear their mask, doesn't that remove some incentive for those that haven't gotten their shots yet? Why would they do it if they're still going to have to mask up?
Yeah, I mean, it's really unfortunate that, you don't get that benefit of being vaccinated and going without a mask. But, right now we don't have the vaccination rates that we need to have to be able to put that incentive back. And with Delta, it's more transmissible. It looks like people who are infected have a lot more virus in their nose, so they're breathing a lot more out. And so with kids being unprotected generally, it's really kind of what has to happen.
So I have seen a lot of studies, Dr. Gronvall, pointing out that kids don't get severely ill from COVID, as well as the fact that the vaccinated don't get severely ill from COVID. I don't know any numbers, specific data backing that, but can you tell us, for example, what are the chances of me as a vaccinated person, or say my nephew who's 11, getting severely ill from COVID?
Yeah, so, I mean, kids do much better than adults, but I think that if we had no adults or no seniors who are afflicted with this disease, people would be pretty concerned about the effect that it has on kids. There are kids, 1 in 1,000 infections that get long COVID. We don't know what's going to happen in the future. There's a lot of unknowns with this new virus. So what are we going to see 20 years, 30 years, 40 years down the road? And so I think the kids need to be the most protected group here. And I would love to see vaccine accelerated for children, because I think now the risks are higher to be unvaccinated.
A lot of uncertainties, of course, but I'm wondering if there are any lessons to be learned from the Delta variant as it spread in India. Began in March, it peaked, it ended around mid-May in terms of the peak of the severity. Could we look at that model and say, okay, the CDC guidance for more masks, just how temporary or long will that need to happen?
Right. We're already seeing some dips in the UK and Israel. So, I mean, clearly these public health measures are working. I'd like to see a lot more vaccine, though, a lot more people taking up the vaccine. So we're starting to see more mandates, workplace mandates. I think that's an excellent idea. The time for the carrots are still there, but we need to protect the people who are can't be vaccinated, and give the people who have already stepped up a break.
Doctor, you mentioned Israel there, which is one of the places that is now offering a third vaccine shot to people who are immunocompromised. You also have places like the Dominican Republic now offering a third shot to people. Is that something that here in the U.S., the Biden administration and the CDC should be more seriously considering?
I think it is under consideration for certain groups of people. So people who have had liver transplants, for example, they may benefit from a third shot. And a lot of people have already taken this advice on the advice of their doctors. But for most people, the shots that we have are sufficient. We need to be doing more to make sure that we vaccinate the world, because we're just going to keep going through this as long as we don't make more of the global population immune.
Dr. Gronvall, thank you very much for joining us. Dr. Gigi Gronvall there of Johns Hopkins. By the way, the Johns Hopkins Bloomberg School of Public Health is, of course, supported by Michael R. Bloomberg, and he is the founder of Bloomberg LP and Bloomberg Philanthropies. Coming up in the next hour, more on the virus with Dr. Bhakti Hansodi, Johns Hopkins Associate Professor of Emergency Medicine. That's at 6:30 a.m. in New York, 11:30 a.m. in London. We all want to know as much as we can now that those of us who are vaccinated may have to go back to wearing masks indoors. This is Bloomberg.
I'm really enjoying my life at Netflix right now. I feel like we've just gotten started there, and I can't wait to keep building on that and enjoy that, making new shows there, working, building on our podcast world. Enjoying those worlds is exciting to me.
That was Shondaland CEO Shonda Rhimes, of course, the genius behind shows like Scandal and Bridgerton. And you can watch that full interview tonight on the David Rubenstein Show, Peer-to-Peer Conversations. That's at 9 p.m. New York time. And it's time now to chat with Tom Keene, co-anchor of Bloomberg Surveillance, who's joining us now. So, Tom, it's a big day. We're digesting big tech and, of course, waiting for the Fed. What are you focused on?
Well, I'm focused on Jay Powell's going to say, look at American technology. It's world-class and world-leading. Yes, the Fed's important, but I think the underplayed is what we've just observed with these three tech companies, what we're going to see with Amazon tomorrow, Kailey. The chart's real simple. It's just a normalized chart of Apple, Google, and Microsoft. Not all that informative other than the massive Apple outperformance. We all know they've done better than anybody else. The revenue build, Kailey, in the big four, Microsoft, Google, Amazon, and Apple, from 2019 to 2022 is the size of Apple's revenues in 2019. That's how fast they're growing.
Wow.
They've grown, based on the estimates of 2022, they've grown an Apple in 3 years.
I'm looking at, Tom, I'm still focused in on what's going on in China. We've got this continued clampdown reaching further and further out now into real estate, and it's not great for Evergrande. But you also see the yuan continue to fall. When does the rest of global Wall Street start to catch up to this?
Well, I think they're on the story, Matt, but you make a very good point. It's tangential, and what's really important, Matt, is glasses in China are a boom business. They're probably keeping Beijing in power right now, the manufacturer of black plastic glasses. It's a great and beautiful thing. It's a really serious issue, and as you know, Matt, it all goes back to property in the one way the Chinese can invest. We have to remember their capital flows are nothing like ours. I think underplayed is the artificiality of their markets, and all we've got left to look at is renminbi 6.50 today, a little bit weaker over the last couple days.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And for our London DAB digital radio listeners who did not just have the pleasure of seeing Matt Miller doing his best Tom impression with his black rimmed glasses, I encourage you to check it out on the Bloomberg Surveillance Twitter. We'll post it for you. Now time for a look at what else we are watching. And Matt, cars.
Yeah, I'm watching Ford. I mean, we have seen such incredible sales growth with these car makers, and really they've sold out a lot of them. You just can't find, for example, a Mustang Mach-E on dealership lots. They've gotten incredible pricing power. Sometimes we're looking at $10,000 or $15,000 over sticker price. This is the new Ford small or medium-sized pickup truck, the Maverick, which has been, at least on social, an incredible hit because it starts at something like $20,000. But this is going to be great because we know we're going to find out more about how Americans are spending their savings, and we're going to find out more about inflation. The Fed should be paying attention to this, and the supply chain issues.
I just want to know when you're buying that electric F-150, Matt. When is that happening?
It's going to be a little while because I still think this is the last chance I'm going to get to buy a big inch V8. So my next purchase will be a 6.2 liter or 6.4 liter V8, and then I'll start going electric.
Yeah, get the double V8, Matt. All about that. Definitely. Rev up. Well, look, I am watching Facebook earnings. We had a lot of the big tech already yesterday. The bar is set so high for them just because advertising revenue has hit it out of the park when it comes to Twitter, Snap, Google, all of them delivering really strong results. So Facebook needs to show up. And we saw with Apple earnings, for example, it takes a lot for investors to be impressed this quarter. So after the bell today, Facebook, that's what I'm watching, Kailey.
All right, and about 2 hours before that, Danny, of course, we'll get the Fed decision, which is what I am watching. Of course, the Fed's going to talk about tapering. It's probably not going to make any moves in that direction yet, but discuss when and where to start. And especially with inflation expectations coming down, yields coming down, and the risk around the Delta variant going up, I would expect that Jerome Powell and co. are going to use the word patient a lot, especially in that press conference later on. And of course, all of this decision today is setting us up for Jackson Hole next month, which I feel, Matt, is what the market really is going to care about.
I think they're really going to just push forward, try and punt to Jackson Hole because they probably don't want to roil markets any more than they need to at this meeting.
Yep. 1 month from today, Jackson Hole. We'll all be waiting for it, but of course, waiting for that Fed decision at 2 p.m. Eastern time. They will be talking about that on Bloomberg Surveillance. More of that is ahead. This is Bloomberg.